Charts are plunging. Headlines are flashing red. As Bitcoin slides towards 63,000, the atmosphere across the market grows heavy with anticipation. In moments of high volatility like this, attention inevitably fixes on strategy. They are the largest corporate holder of Bitcoin on the planet, having built a massive reserve not with idle cash, but by accumulating billions of dollars in debt. This reliance on debt creates a powerful leverage dynamic. When Bitcoin prices move upward, the returns are amplified significantly. However, when prices trend downward, that same leverage begins to exert intense pressure on the company's balance sheet. This pressure fuels the market's primary fear, the margin call. If the value of the Bitcoin collateral falls far enough, traders worry that lenders could force an immediate, massive liquidation to cover the debt. Analysts watch these price levels closely because of the potential for a chain reaction. A forced sale of this magnitude would dump an enormous volume of Bitcoin onto the market at once, potentially overwhelming buyers and triggering a broader collapse in prices. To determine if that liquidation risk is real, we have to look past the headlines and examine the specific structure of Strategy's debt. This is a standard retail margin loan. If the asset price falls and hits this red line, the broker has the right to immediately seize and sell the collateral. It is a rigid, automatic trigger that the borrower cannot stop. Strategy uses a different instrument, convertible debt. Unlike a margin loan, these obligations are set to mature years into the future, and their repayment schedule is not tied to daily fluctuations in Bitcoin's market price. These notes carry low interest rates and, most importantly, lack the covenants that allow for an immediate margin call. Even in a severe price drop, lenders generally cannot step in to seize the Bitcoin held by the company. Based on this architecture, the widespread fear of a bank-enforced liquidation is a misunderstanding of how the company's financing actually works. If the company is technically shielded from a forced sale, we have to ask why traders remain so reactive to every dip in price. In crowded financial trades, the collective perception of risk often moves much faster than the underlying financial reality. This creates a self-reinforcing loop. It starts when Bitcoin drops. As the value of Strategy's primary asset falls, the company's reported book value shrinks, which makes their overall debt load appear much riskier to the outside world. Short sellers often seize on this narrative, arguing that falling collateral values increase the company's fragility. Their selling pressure drives the stock price down, which generates more fearful headlines and further accelerates the decline. This leads to the risk of implied dilution. If the stock price remains depressed due to fear, the company's ability to raise new capital or refinance its existing debt becomes far more expensive and difficult. The danger to the company is less about a legal trigger pulled by a bank and more about a crisis of confidence, where investor panic creates the very instability it fears. This dynamic extends far beyond a single corporate balance sheet. Over time, Strategy has become a central piece of the global financial infrastructure for digital assets. The market views the company as a proxy, a regulated, liquid way for institutions to bet on the long-term adoption of Bitcoin. Because of this role, when the stock suffers under psychological pressure, the broader market reads it as a signal. A decline in Strategy's valuation is often interpreted as a waning appetite for Bitcoin among major institutional players. This creates a contagion effect. When this central proxy shows signs of stress, it sends a pulse of fear through connected sectors, hitting crypto miners, digital asset exchanges, and even traditional technology companies with crypto exposure. While the $63,000 mark is an important technical level for traders, the stability of the entire ecosystem rests on the market's collective ability to tolerate the volatility of its largest institutional participants.